Welcome to this fireside chat on China's opening up, its resilience and its sustainability. My name's Simon Cox. I'm an emerging markets editor for The Economist based in Hong Kong. And I'm joined by Thomas Fang, who's head of China Global Markets at UBS. Thomas, welcome. There's been lots of talk about decoupling between China and the US. And of course, it's very ironic because for a long time, China has sought to be semi-detached from global financial markets. Now there seems to be something of a reversal of roles where China seems quite keen on opening up financially and America seems to be having some doubts about the advisability of those links. Can we start? I know that you've been shut out by the pandemic from the mainland since Chinese New Year, but I understand you've just spent 5 days doing a tour of the mainland, your first visit for many months. So what were your impressions?
Well, first of all, it's a great pleasure to be here. Yes, I just finished the 5 weeks trip back to the mainland China. It is so impressed in terms of the activities in terms of economics, right? So the malls are full, and it's hard to get restaurant booking. And the hotel is fully packed even over the weekends. And one of the most impressive part is when I met the policymaker, they are more committed than ever in terms of executing their capital markets reform and then continue the open up strategies. And to answer your earlier questions, there are decoupling talk more from, in my view, the geopolitical front. But in terms of economics, especially for the financial sector, actually the coupling is really what's happening.
And what's motivating that, both on the Chinese side and from the point of view of the rest of the world?
Sure. I think for China to achieve the next phase of growth, as the leader has set out a couple of weeks ago in terms of their 14th five-year plan. So they need to find a new engine. It will not be continue to be the sort of the debt-led growth, but they need to really utilize the capital markets. At the same time, to increase the service sector productivity, especially the financial sector productivity. So they are looking at global leading financial institutions to come into China, set up the presence, show their best practice so that to increase their overall service sector, specifically financial sector productivity. But for global financial institutions, it is really both the alpha and also the business growth. By talking to the leading CIOs, they definitely agree. So China are one of the few factors can generate alpha. At the same time, to look at the growth for their business, China is definitely the place to be with growing asset under management, institutionalization, and also more equity and a fixed income investment opportunities.
And why is it, do you think, that foreigners can generate alpha in China? Why isn't it the domestic players that will steal those investment opportunities?
Actually, both. So they are actually learning and interacting together. It is not mutually exclusive. I think, but for global investor, what is the catalyst was really many major index added China into their overall global benchmark. So that leads to overall a must to look into the China equities and the fixed income market. At the same time, for global investor, it is the beauty of diversification. They need to look at geographically how to diversify their portfolio. And China being the second largest equity and the fixed income market, both in terms of the size and the liquidity, is a must for them to consider.
But the index inclusion, diversification, both of those imply a somewhat passive exposure to China. Do you think foreigners should be brave enough to explore more active participation, and why should they have an edge?
Overall, both passive and active manager are looking for global benchmark to position their asset allocations. But you are right, 50% of the overall, I think, inflow, we will categorize more index follower or passive. But for active, they are putting money. Ever since, for example, MSCI inclusion in 2017, the overall foreign holding for the China equity market have increased 4.5 times just over that 3-year period. So that includes both passive and also increasingly active managers, including quant fund as well.
And do you think that they bring something to the table that local players don't have?
Oh, definitely. I think one of the key things I think Chinese industry leader love to do is learn from the best. And if you look at any dimension in terms of tracking track records, AUM, and other methodologies, and the global asset manager are definitely the leaders. They come in to share with their overall investment and a risk management philosophy, but at the same time, mutually learning from domestic institutions in terms of how do they analyze specific sectors growth and how their valuation different, even in the quant space, exchange talent, model, and factors in many ways to enhance return growth at the same time.
Now, China used to be quite sort of suspicious of what it saw as fancy finance and sophisticated financial strategies that perhaps it didn't fully understand. What's precipitated the change in view on China's part?
There are quite a few factors. I think from policymakers' point of view, I think what really changed their perception of global investor was 2018. When it had a very difficult year from a equity investment perspective, and with a major downtrend for that particular year. But for that particular year, there are two factors. There are massive foreign inflows into that Chinese equity and bond market. At the same time, there are, the financial instrument like futures and some of the hedging strategy in many ways help the market. So the policymaker in many ways realized, global investor can be very helpful, and then financial instrument can be risk management and the price discovery. At the same time, they come in with a little bit more confidence with the growth of the size of the economy and also the general capital markets with relatively healthy return now 2 years in a row, and also attracting both fixed income and also equity investors globally.
Do you think there's a ceiling on how well China's authorities will let foreign investors do in China, how big foreign financial firms can get? Do you think authorities have some sense of a ceiling that they're comfortable with?
Yeah, that's a great question. And I think like any domestic regulator, there's always this two-pronged approach where to attract global leaders, but at the same time, in some way protect the domestic players, right? So we definitely see policies around setting up what they call super players within financial sectors such as investment banks and increasingly insurance and wealth management company. But at the same time, I think this is really at the earliest stage of structural growth. So I categorize this as a sort of a golden decade for capital markets open up. So for foreign ownership, even with that increasing velocity of investment, the overall holding as a percentage of free flow, for example, for stock market, grow from 2% to somewhere around 8%. So it's 4 times growth, but still it's 8% only. I think at some point this will become a equilibrium where how a policymaker will balance both the domestic and the global, but I think we are far from there.
And you mentioned the importance that China's leadership places on financial reform in its growth strategy. Do you think it's right to place that much importance on financial reform? This may sound like a silly question, but is it really the financing side of China that's the binding constraint on growth? Or is it really the non-financial corporations that need to change? I mean, to put the question more crisply, can we achieve anything with financial reform if we don't get more thoroughgoing market and SOE reform?
You definitely asked one of the critical questions when we interact with different policymakers, especially outside of the financial industry. So they care more about real economy. They often question how would various financial reform and foreign participation have an impact on the real economy, rather than just to, sort of borrow cheap and then lend it higher, or buy low and sell high, right? But one of the critical factors, especially along with the capital market opening and reform, is this is the engine where using market force to do price discovery, and then more importantly, to have a better asset allocation. If we look at overall growth, inputs, it is the human capital, it is the financial capital, and then technology and increasingly data, right? So with the key inputs, so then the asset and precious resources can be optimized and allocated to the right company. So that's really will be the key driver for the economy.
You mentioned technology and data, and we've had a question, of course, it would come up. We've had a question about Ant Financial from the audience. And what implications do you think the new regulations and the postponement of that listing, what implications should investors draw for other companies and other financial strategies?
I agree. I think Ray made a very good comment yesterday. We shouldn't really overread, I think, the news. I think, in my view, in many ways, this is quite consistent with the Chinese policymaker in terms of have that growth and entrepreneurship protection, but at the same time, in a regulated manners, right? And the financial industry, especially with regards to lending and a capital requirement for various lending entities, is a global sort of philosophy and then regulatory standard. So I think I would be, not overreading this particular event, but I agree. I think the timing-wise, it's a bit of surprising to the many of the market participants.
And also the new antitrust regulations in draft form that seem to be targeting some of the tech giants. Is that also a source of regulatory uncertainty that foreign investors should be aware of?
I think this is also, in many ways, a global trend. So how I think regulator are looking at the in many way technology disrupting world, and then balance that antitrust or the culture and a soil of entrepreneurship, but at the same time, protect the leading players. In many ways, they are produce as many patents and innovative ideas as the smaller player. I think it's a tough balance act. I think it requires, in many ways, global exchange of best practice. It is uncharted sort of a territory, but I think has a certain level of transparency and the regulations, even for the tech sector, it is inevitable in China and the rest of the world.
Can we talk a little bit about sustainability? We've obviously had this quite bold pledge from Xi Jinping to go carbon neutral by 2060, a more longer standing pledge to be to reach peak emissions by 2030 or so. Is that realistic? I mean, given coal's dominance, and what investment opportunities might that create?
Well, simply put it, I wouldn't bet against it. Actually, if we look at the new investment opportunity, I'm definitely a key believer for ESG, in particularly for China, for environmental related investment, especially on renewable energies. if you look at other than Tesla, auto-related EV, car maker, hitting the capital market and enjoy the similar growth like Tesla and other leading players is really encouraging. So I would think China is doing the right thing in terms of focusing on environment and climate change. And in many ways, it's not very popular from a growth of GDP, pure GDP growth perspective. But I think it will, provide the sustainability for its long-term growth.
And I'd be remiss not to talk a little bit about the US attitude towards China. How do you see that affecting the financial reform and the opportunities for foreign investors?
2018, again, it was a unique year when China's equity market suffered a downturn, and also the trade war. I think overall, the Chinese investor and the general public sort of learn how to react, and hopefully with the election behind us soon, it will be a more predictable negotiation patterns, and this will be good for the U.S. and China, and also I think will be good for the overall the whole world.
We did see, though, quite a lot of financial opening up during the Trump administration from China. Do you think there's a case to be made that the trade war helped precipitate and hasten some of that financial opening up?
Timing is actually quite interesting. So in many ways, I think if we look at how Mr. Deng Xiaoping pushed through the reform, sometimes external factor does help to drive consensus internally. Oftentimes, when there is a relatively amicable environment, there will be voices of maybe you open up too fast, and you're giving too much, and then why you share the pie with foreign players. But I think with the past 18 to 24 months, I think the consensus is getting stronger. China is one of the key beneficiaries for globalization, and they definitely want to make sure the coupling, especially in the financial sector, will continue and strengthen to be so-called the anchor for globalization and then their next growth.
And we've also had a question from the audience about the virus, about the pandemic. Do you see that as a source of friction or potentially a source of new collaboration between China and the rest of the world?
I think it goes through stages. At this point, I think it is definitely new opportunities for the world and China to collaborate. So when I was in China, there are a vaccine and a lot of the best practice, I would say, versus Hong Kong, and I think we should definitely encourage that to happen in terms of more collaboration rather than confrontation.
Thank you. We've run out of time, but thanks. That was a great chat, and I hope you'll stay with us for the next session.
Thank you. Have a good day.